Hello and welcome to KYC on NDTV Profit. On this show, we're going to talk about a stock that has gained over 30% in the last 1 month. This is at a time when viral and flus are on the rise. Is this hospital a beneficiary? We will get to know that. We're talking about Shalby. Welcome to KYC. I'm Hiral Dadia and with me is Varsha. Clearly, this is an interesting time that we're talking to the company as well, when the entire season is with regards to virals and flus. But yes, Shalby does do a lot more. First, let's quickly understand what are the key answers that we want from the management so far. First up, the occupancy ramp up in Shalby Sanar. What is that actually going to look like from here on? Because that is the key in terms of the recent acquisitions as well. Secondly, when you talk about the Mumbai Greenfield Hospital, the timelines with regards to execution and operationalization of the Mumbai Greenfield Hospital is what we will be watching out for. And very lastly, if you talk about the company's implant business, now that is something that we should be looking out for because it actually sits under Shalby MedTech, and this is a key part of the company's long-term growth strategy and diversification plan as well. So these are the first three important points, Varsha, that I'm looking at.
Well, what I am looking at, one is the growth in average revenue per occupied bed. Because, Shalby is at such a phase wherein at a certain point of time, you cannot increase your ARPOB beyond a certain level. So we might want to understand what is that ballpark percentage that Shalby is expecting when it comes to growth in ARPOB. Then I would also like to know the EBITDA margin stability. Because in Q1 FY26, if you see, the margins were under pressure. Now this was because of high doctor costs. So I would want to know what is the sustainable EBITDA margin going ahead for next 2 to 3 years. So these are my two main questions that I would want to ask to the management.
Absolutely. In fact, let's shift focus and understand more about the company. Shalby operates a chain of multi-speciality hospitals, and this is across India. They have 11 hospitals which are spread across Western, Northern and Central India. A franchised hospital network is what they look at as well. In fact, Implant is another segment that they're looking at. They manufacture US FDA approved implants and sell them across the US and other international markets as well. The plan is to make this $100 million business in the future, and that is one of the pressure points right now that the company is facing.
Right. And also we might want to understand what are the business highlights, when it comes to Shalby hospital business. So if you see the ARPOB, that is average revenue per occupied bed, which is an important metric in an hospital, which stands at around 45,673 rupees. The operational bed, if you see, is at almost 1,400 odd. The occupied beds stand at 639 beds. With that, if you see, the occupancy rate is at 45%. Also, onto the average revenue per occupied bed, if you see the trajectory, company has seen a decent growth, when it comes to ARPOB. So in FY22, the ARPOB was 32,106. Fast forward to FY25, it stands at around 41,377. So good growth we have seen in ARPOB when it comes to Shalby.
Okay, so that's with regards to where the ARPOB go, but let's understand the segmental mix as well. Now, it's a specialty business, so the revenue mix is also pretty interesting. Arthroplasty, 41% of the revenues come in from here. Orthopedic contributes around, say, 10%. Oncology is pretty similar, and others is around 40%. So that's the kind of revenue breakup that you're looking at across verticals.
And also, Hiral was talking about Shalby Sanar, which is an important acquisition that the company has done. And why this is important? Because that will outline the growth going ahead. So onto the Shalby Sanar, the ARPOB for that stands at around 89,803 rupees, while the bed capacity is at 130. The occupancy rate over here is only 22%, which management want to increase it, going ahead. So overall, if you see the pain point in Shalby Sanar is the occupancy rate, which is at only 22%.
Okay, so that's a question we will check with the management, Varsha, but let's understand all the parameters that we are going to consider from here on. First up, you have the income statement check that we will be doing. Balance sheet is another one. Cash flow return ratios are very important over here as well. Shareholding, street cred and valuations along with the outlook is what NDTV profit is considering. But first up, let's quickly look at the income statement. It's very interesting because it's consistent and robust upward trend is what we've seen in revenues over the last 3 years. Between FY23 to 24, the growth did stabilize at around 15 to 16%, which indicated sustained business expansion. If you talk about the operating profit as well, that has seen a significant growth, and the growth on both these parameters is actually translated into profitability, which you can always see on the screens right now. Though what is interesting is in FY25, the profit number was only 2 crores, and a lot of factors that have impacted as well. The recent performance is also suggesting margin pressure, and this is potentially on the back of the acquisition which has been made, because over there occupancy was lower initially and the finance cost was also higher. We're talking about acquisition of Sanar Hospitals. In fact, it has been a significant point of concern right now. The new hospital has actually faced slower than expected occupancy rates and has been operating at a loss, negatively impacting the consolidated margins and profitability. In fact, the management is expecting the facility to break even in the near future, but its performance will remain a key credit monitorable from here on. And the challenge is effective integration and scaling of the newly acquired expanded facilities to maintain the margin trajectory. And very lastly, when we spoke about the implant business, this division, while expected to contribute to revenue diversification, has actually faced challenges, and it is evident in the kind of profit growth and the margins that you're seeing, because it is a high working capital business with a significant inventory that is holding up, and it's yet not become consistent in terms of profitability. Expenses are also high, and that is what is impacting the margins, and the margins have been fluctuating over the last couple of years.
Now, talking about the balance sheet, let's see what are the key concerns there. Well, overall, not a dramatic one. The good thing is the debt to equity ratio, if you see, stand at around 0.48 levels, though debt has been increasing, but not at an alarming sign. So, and if you see the cash and bank balance, which has increased from 12 crores to 35 crores. So, overall, not a dramatic one. So, we have given a neutral rating when it comes to balance sheet.
Okay, so that's the balance sheet. Now let's look at the cash flow. Now, there has been an increase in the working capital days of Shalby, and that is what has actually locked up most of the cash in the business. Acquisitions have dragged the cash flows, and this is on the back of initial losses, lower occupancy, as well as the integration costs, and hence a downtick. That's a thumbs down on the cash flow, because your net cash flows, though have turned positive this time around, your cash flow number is negative at around 4 crores.
And talking about return ratios, let's see what's happening there. If you see return ratios, there's been dip in FY25 from FY24 levels. This is because of the impact of the profitability that we have seen, and one of the reasons is also the higher tax outgo that the company has seen. So overall, if you see the return ratios barring FY25 is good compared to its peers like Aster DM or Yatharth Hospital, but because of this a pressure in profitability, that 14% we are seeing for FY25, and that's one of the reasons why we have given a neutral rating when it comes to return ratios.
So that's with regards to return ratios. Let's look at the shareholding pattern from here on. Overall, promoters absolutely consistent. FIs have actually gone ahead and increased their stake from a 4.88 to a 5.21, which is a positive. Likewise, the DIIs have also marginally increased the stake as well. And your public shareholding slightly has gone down, though your shareholder base that has increased. So taking these three aspects into consideration, we've given it a thumbs up with regards to shareholding pattern.
Considering street cred, so in the last 1 month, company has given a very good returns of almost 30%, while in last 5 years, the stock is up 190%, though in the last 1 year, the stock was down almost 10%, but overall, if you see, that's, considering the returns that a company has given, not a bad one. Even if you see the year-to-date returns have been around 9%, and so, the last 1 month, the stock has given actually very good returns, and one of the reasons why we have given an upward rating to it.
Okay. Let's look at the valuations over here. It's a very interesting aspect to look at the valuations here on, because if you have to compare it to peers, it probably sits in on number 3 in terms of being expensive, because you still have an Aster DM and KIMS, which are way higher as compared to a Shalby. And it's not only in terms of FY26, but even if you talk about FY27, the scenario remains the same. Now, with this kind of inconsistency that we've seen in terms of the earnings right now, I'm talking about the latest quarter, the investments that it is making as well, I think what analysts are of the opinion is that the outlook is something which is supporting the kind of earnings multiple that a Shalby is sitting on. And taking the outlook and the current and the future multiple into consideration, if it all fits in well and is able to perform, that is what we have to see, and hence a neutral rating in terms of evaluations go.
Right. Now, lastly, combining your analyst recommendation and outlook. Well, on analyst recommendation, there are not much analysts who are covering this stock, and hence there are only 2 analysts who have given buy rating, 0 hold and 0 sell, while the downside potential for is 15%. But then we have given a thumbs up. Now, this is basis outlook that the company is expecting. So, they expected the EBITDA margin with operational leverage and business mix shift. So, the EBITDA margins are bound to inch up. The occupancy is expected to touch at 50% plus for FY26, and the government mix is expected to reduce to 20% of revenue, and the single digit EBITDA margin is been expected for their implant business in FY26 and 27, and which will scale up to 20 to 25% in next 4 to 5 years. So, good outlook, when it comes to FY27 and of course for the next 3 to 5 years, and this is the reason why we have given thumbs up when it comes to outlook.
Okay, so those are the parameters we are considering, but let's quickly look at all the parameters, the 8 ones, what do they stack up? Income statement, balance sheet, return ratio is a neutral, cash flow is a thumbs down. On the other 4, you have 3 thumbs up, which is shareholding, street credentials and street coverage and outlook. Valuations, again, neutral. And this takes us to a 5 on 8, which is also a pretty good rating in terms of where KYC goes. And the conversation from here on is going to be interesting, because Varsha did catch up with Shanay Shah, president of Shalby, to discuss the company's outlook and the plan of Mumbai Greenfield project. Let's quickly listen into that conversation.
Let's talk about what is the talk of the town when it comes to Shalby, because of the Delhi acquisition that you made, that is Sanar. The occupancy there remains low. I think it was almost 22% in Q1. Now, what steps are being taken to ramp up it quickly, and where do you want to take that occupancy level to?
Sure. So, look, Varsha, thank you for having me. We have seen that, usually we take 2 to 3 years for a hospital to really turn around. Essentially, this is a hospital where, it's been 6 quarters since we've taken over. And we have taken the right steps over the last, 6 quarters by getting the right clinical talent on board, as well as, the entire management rejig that happened at the senior level. So, the worst is behind us, and, we will see that the numbers will start improving, and they have started improving. In a couple of months ago, we also had an issue with, due to the Middle East crisis, and a lot of the patients, were not traveling into the NCR region at that time. So that did temporarily affect us. But, as I said, it's a high-end center for transplantation, whether it is liver, kidney, bone marrow, all high-end treatment happens at that hospital. And we are getting good traction, not only from international patients, but also from, the domestic patients, as well as patients traveling in from the neighboring states.
Understood. Also, Shanay, when it comes to your standalone hospital business, the margins over there were dropped due to higher doctor cost. When do you expect that margin stability, and what is the sustainable margin when it comes to hospital business going forward?
See, over the last few quarters, we have, kind of added a lot of doctors, and, we have, including some of the star doctors in some of these locations. So, we are building institutes of different specialities across all these different hospitals that we run. And for that, the initial investment is to get the right clinical talent on board. And that is the reason why we saw that, the earnings as a percentage to revenue has come down. not very significantly, at the absolute EBITDA level. But in the times to come, we do believe that we will stabilize, and we are looking to be at anywhere between 20 to 23% in this year.
Understood. Also, continuing on that, your Mumbai Greenfield Hospital, now that, Charity Commissioner has, the approvals are in place, what is the expected timeline for final approvals and handover?
So the charity commissioner, as you rightly said, has given the nod to us, and what we have to do now, as the trust is obliged to kind of submit the document to the charity commissioner, the document which has been agreed. So they are in the process of doing that. Once that is submitted, the following that the other formalities will be completed, and then we will be going in for the approvals. With the BMC for the building plans, etc.
Usually, just wanted to understand a ballpark number, or rather ballpark months, if you could give us, by when you're expecting this project to go live?
So after the complete handover of the property to us, which should happen hopefully very soon over the next 3 to 6 months. Once that happens, it should take us roughly 3 years to kind of operationalize the hospital.
Understood. Also, continuing with the Mumbai, Greenfield Hospital, what is the expected bed capacity and target revenue per EBITDA once it becomes operational?
Yeah, so this is going to be a 175 bed facility where Shalby will be investing close to 250 odd crores. And it is a pure revenue share, with the trust. So there's no fixed lease arrangement here. And the average revenue per occupied bed, if that is what you were asking, in Bombay has been in the range of 50,000 to 60,000 for most hospitals. So we will be in that range for the Bombay hospital.
Continuing on that, Shanay, so if you see in Q1 FY26, the ARPOB, that is average revenue per occupied bed, was almost 45,000. Now, after a certain point of time, it's not possible to increase ARPOB at a certain level. What is the growth estimation when it comes to ARPOB, maybe, in next 1 or 2 years?
So see, I think for Shalby, the ARPOB has consistently gone up over the last several years. So if you look at the data 5-7 years ago, 5 years ago, we were at around 30 to 33,000. Today we are at 45,000. We believe that the ARPOB growth will continue to be in the 4 to 5% range, on an annual basis. Now it may happen, it may be that you may see that there is a spike of 10% in 1 year. At times you will not see a spike in a particular year, because the specialty mix also changes, and different specialties have a different ARPOB. So that might change, but in terms of the price revisions are in the range of 3 to 5% every year.
Understood. So 3 to 5% is what ARPOB growth is expected. Now, Shanay, let's talk about your implants business. Now, the revenue over there has seen growth of around 20%, but the EBITDA is still negative. When do you expect EBITDA to break even?
Yeah, so see, there are a couple of major changes that that is expected over the next 1 to 2 quarters. And these major changes, will basically help us reduce our cost of goods, and at the same time improve our gross margin because of higher revenues and higher earnings per implant. Because we are launching certain implants which will actually give us a higher realization compared to our existing set of implants. So with these couple of things changing, and as you can see in the revenue growth, the acceptability of these implants is very high among the clinicians. Now, this is something that will take a quarter or two, but we do believe that once that comes in place, we will definitely be EBITDA positive. and also, then be inching for a higher EBITDA margin.
Understood. And any revenue target that you have set for implant business, Shanay?
Yeah, so we have set revenue targets. Unfortunately, we are not sharing these revenue targets, at the moment. But this is a business which is grown significantly. So last year we did about 90 crores. The year before that we did about 60 odd crores. So it is growing at 50% for us, and we believe that it will continue the high growth trajectory.
Understood. Also, Shanay, a significant portion of debt is been linked to implants. Now, when do you expect your debt to meaningfully reduce? Any target that you have set for that?
Well, if you ask me, the debt equity ratio right now is roughly 0.3 to 0.4. So, we feel that, we are basically in a very comfortable debt to equity kind of position. Having said that, the plan is not to increase the debt, very significantly from here on. We believe that our internal accruals, in the hospitals business will take care of the interim requirements of funding, the implant business, as well as, some of the newer strategic interests of the group, like the hospital in Mumbai.
Understood. Shanay, my last question, before I let you go, you have given a top line growth target of around 12 to 15% for FY26. Do you want to inch that up, number one? And number two, what are your target for EBITDA margins on a consolidated level?
Right. So, unfortunately, I will not be able to share, the numbers in terms of, what the EBITDA margins will be. But I told you that, we will be in the range of between 20 and 23% for the hospitals business. And in terms of, the revenue growth, we are well positioned because as I discussed, the implant business is in a high growth trajectory, and we are heavily investing in newer clinical practices. As I mentioned earlier, we are also investing heavily in oncology in terms of adding new linac bunkers in 3 of our hospitals, and also robotics in a very big way. So, the robotics within orthopedics for knee and hip replacements has really picked up very significantly for the group. And all these factors, will really help us, beat some of the past trends in terms of, our revenue growth numbers.
Well, this was the management of Shalby Limited. The top 3 takeaways from this interview would be: they expect unit economics for Shalby Sanar to improve. EBITDA margin for hospital business is expected at 20 to 23% in FY26. And lastly, implant business to be EBITDA break-even after few quarters. So all the main pain pointers have been addressed.
Absolutely, all pain points that the management has addressed, and the stock seeing some good moves, but completely out of time. Thanks for tuning in to KYC only on NDTV Profit for your profit.